Today's video is sponsored by Skillshare. So when we work with our clients, real estate is one of the main things that we bring into the picture and we have a discussion about. So for this week's video, what I want to do is compile a list of tips and tricks when it comes to real estate purchasing. Some of these will be more common while others are less known. So no matter if you're buying your very first home today or you're purchasing investment properties, hopefully this video is gonna up your real estate knowledge and also improve your real estate game. And before we start, if you could do me a favor, hit the like and subscribe button to show support for this channel. Now, without further ado, let's jump into today's video. So let's start off with the pre-sale perspective because nowadays that's what everybody is buying usually. And the first tip is that if you borrow money to put a deposit on your pre-sale while it's being built, you cannot write off the interest. This was actually something I wondered about 6 years ago when I was looking at my Surrey pre-sale. I actually called the CRA to verify if I can write off the interest if I borrow money for the deposit. Now after discussing, CRA agent came back and said, in fact, I cannot write it off. And the reason why is because for CRA's rule, it states that in order to write off the interest on the borrowed amount, the investment has to have ability to generate income consistently. And since a pre-sale is not yet built, there's no way I can rent this to anyone, and so there's no ability to generate any income. Thus, I cannot write off any interest while it's being built. However, it doesn't mean I lost the tax saving. If I borrow money and I pay interest during those times, those interest payments would instead increase my ACB, adjusted cost base of what it cost me to purchase this unit. So my ACB is going to be my purchase price plus interest paid during those times that I didn't get to write off, plus any associated fee that comes with buying or selling the unit, for example, lawyer fee, etc. Now here it might sound like the write-off is not as efficient because before, if you could write it off, it would be against your income, which is 100% written off. But if it's ACB, it only benefits to write off your capital gain, which is at 50% write-off. However, given the fact that capital gain is usually a lot larger when you sell your property, the actual write-off amount, the actual tax saving amount, probably is going to work out roughly the same, if not better. So it's still not a bad idea to potentially borrow money and purchase your pre-sale if that's what you want to do. Just know that you cannot write off the interest upfront and you have to save it for later time. Now, speaking of pre-sale, the next tip is going to be about cash out financing. Now, cash out financing is actually a common strategy in real estate investing. All it means is your property grown in value and also mortgage has been paid off over time. You have substantial equity built up as time goes on. To access those equity, instead of selling your property, you can refinance with a bank like a HELOC, for example. Take it out so you can tap into those increased equity without having to sell and trigger your capital gain tax. Now for pre-sale, it's going to be a little bit special because usually it takes 3 to 4 years to finish building. Very, very likely, especially in places like Vancouver or Toronto, the value of your pre-sale by the time it's finished building, it's completed, is probably going to be much higher than your original purchase price. So here is where you need to pay attention if cash out financing is something you're focusing on. At completion, banks usually is going to use the original purchase price to complete the sale. So if you get yourself a 5-year mortgage right on the spot, then you potentially lock yourself in 5 years before you can refinance at the actual higher value of your property. Now, instead, what you could do is get a 1-year mortgage term or use existing HELOC to finish your purchase and then refinance with a bank afterwards. That way, the bank is going to use the most current assessed value, which is likely much higher than your purchase price, to assess what is the max amount they can refinance and borrow to you. That way, you can borrow a lot more in a shorter time, and also sometimes you can even recoup all the deposit you have put into this pre-sale back out for your next purchase if that's what you want to do. Now moving forward, for the third tip, we're going to jump over to look a little bit at the tax side and we're going to talk about the 4-year rule. So in Canada, when you change your property from self-use to rental or vice versa, you would have to file something called a change of use with the CRA. When you change the use, in CRA's eyes, it's deemed disposition. It's as if you have disposed the property at this current time. However, if there is any capital gain to be paid because of a change of use, you can actually elect to defer the tax until the property is sold. Now, the most interesting part about this rule is if you are in the following situation. You own your principal home right now, you're living in it, but you decided to rent it back out, and so you're moving away and you're renting the property to someone else. So you're changing the use from self-use to a rental. But instead of you going out there and buying another property, you're actually either renting somewhere else or you moving in with another family. So at the end, you don't have another principal residence. If that's your case, when you do that, you can actually make an S45 election, which allows this rental home to qualify as a principal residence for 4 more years, despite the fact that you or your family no longer lives in there. Now, for this to work, you cannot do partial change of use, so you cannot just rent a part of it out and change that part. You have to move out completely and rent the whole thing to someone else. You also cannot have another principal residence for the next 4 years, as we have said already. And also, you have to be a resident or deemed resident for the next 4 years in Canada. So this is a more niche situation, but I have seen clients who fit exactly this description. Now I'm going to use a direct example from taxtips.ca as a demonstration. So in there, it assumes the taxpayer owns a property and they have lived in there from 1996 to 2006, so about 10 years. Now, at 2006, they have moved out and they have filed an S45 election, which is change of use. Since then, they have been renting the property out all the way until 2012 when the property is sold. And during this time when it's rented out, the taxpayer didn't claim any CCA, which is capital cost allowance. So they didn't claim any depreciations. Now, when the property is sold in 2012, there would have been a capital gain because it was rented out from 2006 to 2012. So those part of capital gain has to be counted. But because they have made the election, the 4 years rule apply here. So during all those years, the number of years that is sheltered by the principal residence exemption would have been 11, which is 1996 to 2006, plus 1, which is the rule you can do for principal residence exemption, plus 4 extra years because of the election. So in total, this person owned the property for 17 years in total, but they have 16 years to count as principal residence. So what that means is for this person, they have sheltered 16 out of 17 years of the capital gain, and they only have to pay 1 year worth, which is a lot less versus if they have not made this election and they didn't get to enjoy the 4-year rule. So if you're in this situation, make sure you keep this in mind. Now, moving forward, speaking of principal residence exemption, remember that the exemption is not so exempt for everyone. When you sell your principal residence, yes, you do not have to pay tax, but that's only true if CRA sees it this way. If you have moved too often and you're always changing house and selling and moving, CRA has the right to challenge you and say that you're not doing it for the principal residence, you're doing it to flip houses and to make profit. If they challenge you and they win, it's going to count as actual income. So all those gains will be 100% taxed on your marginal tax bracket. So you definitely want to pay attention to this. There has been a lot of cases in the past where people have been challenged. I read somewhere that a realtor, I think in Vancouver, done this 9 times in 11 years. At the end, she lost, and I believe she has to pay, I think, $900,000 in back tax, plus penalty, plus interest, plus admin cost, and also lawyer fee. So if you're in a situation where you simply want to sell a property because you just don't like living in it, or you found something else that's a lot better, if you're selling within 1 year of acquiring a property, especially if it's pre-sale, you want to talk to your CPA about this to see if it's likely going to get challenged, and if you lose, what is likely going to be the tax and the penalty on this. Now, just before we move on, a quick word from our sponsor today, Skillshare. Skillshare is an online learning community for creatives where millions come together to take next step in their creative journey. Now, what I love about Skillshare is that it combines really well-crafted video lessons with projects, so it's not just theory. You're actually going to be doing the work, and that's the best way to learn. Once you sign up, you have access to every single class on the website, anything from creative drawing all the way to finances and project management. For example, I'm currently learning a class called Productivity Masterclass, Create a Custom System That Works by Thomas Frank, who is also a YouTuber. Now, here's the best part. Thank you for Skillshare for sponsoring this video. They're doing a promotion right now. Instead of giving you the usual 14-day trial, the first 1,000 of my subscribers to click the link in the description below will get a 1 full month free trial of Skillshare so you can start exploring your creativity today. Now, moving forward, let's jump out and look at corporate side and look at what happens if you use corporation to own real estate. So my next tip is going to be corporation may be potentially harmful to own your real estate holdings. Now, many times I'm sure you have heard people have held properties inside a company instead of personally. And because the whole thing sounds fancy, a lot of people mistake it and think this is actually a better way of holding your properties. Strictly speaking, on basic level, holding a property inside a corporation is only beneficial from a legal perspective. So if you have worries about tenants suing you, you will lose and you will affect your other assets, then yes, holding it in a corporation may be a good idea. But when it comes to tax saving, if you have real estate inside a corporation, most of the time it's going to be counted as passive income, and all passive income inside a corporation will be taxed at the highest marginal tax bracket in that province. So as you can see on the chart, it is likely going to be around 50% or over 50%. Now, you do get some of it back when you dividend yourself personally, because that way it can avoid double taxation. So you get some sort of refund back. However, you still have to pay the 50% tax upfront first, and that might make things inefficient when it comes to investing. Now, there is a way to bypass this, and this requires you to have 5+ full-time employee, which can also include you. If you have all those people working related to the real estates, then this real estate would now be counted as an active business, and you will get to enjoy a much lower corporate tax rate. But as you can probably tell, this is a hard thing to do, to have 5 people full-time working on a real estate holdings. However, it doesn't mean real estate incorporation is always bad. So here comes my next tip. If you are a serious real estate investor or landlord, then the 3-tier corporate system will be perfect for you. So we have talked about this briefly in previous video, but 3-tier structure is really good if you're looking to accumulate, I would say, anywhere from 5 to 10+ properties. Basically, you will structure 3 companies like this. You have a holding company, 1 or more real estate companies, and then a managing company. Holding company, as the name suggests, is an inactive company and does not generate any income. Its only purpose is to hold 100% of the shares of the property management company and your real estate companies. Now, in addition, another purpose for the holding company is to hold all the cash generated from your rental and property management company. Now, lastly, another benefit for holding company is it allows for income splitting opportunities. Real estate investors can issue another class of shares to their spouse or adult children over 18 of age to allow for issuing dividends to them and thus creating income split. Now, next, for your real estate companies, this is where it will actually own your properties. You can have 1 or more real estate company if you like to further protect each property. So if you want more protection, you can actually have 1 inside each corporation. And moving on, for your managing company, this is where you're going to collect rent, manage tenants, etc. It's going to charge your real estate companies a management fee of 8 to 12%. Now, this is great because this management fee is then counted as active business income, and so it will get taxed at a much lower corporate rate, anywhere from 9 to 12% depending on your province. Your real estate company can also write off as expense, so it pays less tax on that side. Now, this is kind of like a basic setup and something you should probably bring up to your lawyer or accountant, CPA, if you're serious about real estate investing, if your plan is to massively accumulate real estate portfolio in the future. And then on top of that, once you have that set up, you can also do more complicated things to bring in more control and mechanism for things like estate planning. Finally, the last tip is about joint venture and partnership if you have multiple contributors. Now, given how expensive real estate is in Canada nowadays, many people want to jump in and do real estate projects, but they either lack the money or they lack the skill or knowledge to do so. Other than just owning a corporation or 100% owned personally, you can also consider having a joint venture or partnership if you and your friends want to work on a real estate project together. Now, one thing to note is that a JV and a partnership are actually different, although a lot of people confuse them and use the 2 terms interchangeably. Now, in terms of ownership in a JV, all partners directly own a percentage of the property as agreed upon, while partnership itself directly owns the property, and then the partners own a percentage of the partnership. JV is more suitable for properties with less legal risk. It is for more simple and straightforward projects. Also, if you are entering a JV where one partner is bringing in his existing real estate and then giving you a share of it, there may be additional tax issues for JV. In that case, you may want to consider a partnership instead. Now, like mentioned, partnership owns a property directly. For income tax purpose, partnership calculate all income source at partnership level and then flow through to each partner. Partnership can also have more flexibility in asset transfer because it can defer tax in most cases. Typically, a JV is more suitable if it's a one-off thing, if you guys are just coming together for one project, while partnership is more suitable for a long-term operation on multiple projects, or if you have multiple partners coming in for different objectives. Now, one last thing to note is that no matter which one you're picking, especially for JV, make sure your agreement is clearly stated that what is your role here, what are you contributing, because in the past there has been people bringing in what we call sweat equity, which means they are providing labor or using their time, and the court has challenged them and said that your portion should be counted as a business income, so 100% taxed it. But in the end, the person actually won, and he was only able to win because his JV agreement was very clearly written. So if you're planning to enter into a JV, make sure you get a lawyer to read through it and make sure the terms are very, very specific and clear. Alright, so those are my tips and tricks about real estate investing. Now, if you have found them helpful, make sure you hit the like button once. If you don't find them helpful, make sure you hit the dislike button twice. Next one I want to hear from you is, what are your tips and tricks when it comes to real estate purchasing? Let me know in the comment down below. And also, if you like these kind of videos, I do upload them 8:30 EST every Tuesday. So make sure you like and subscribe to my channel. Click the bell button to get auto notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye!